Welcome to our deep dive into the fascinating world of private equity secondaries, often called the hidden market for buying and selling fund stakes. If you're an investor, fund manager, or simply curious about how liquidity is being built into the typically illiquid private markets, you're in the right place. This video will break down what secondaries are, why they're becoming so vital, and what the future holds for this rapidly growing segment of private capital. The private equity landscape has evolved dramatically over the past 2 decades. Once a niche strategy, secondaries have transformed into a critical component of private capital markets, offering unprecedented liquidity and flexibility. Secondaries have transformed from a hidden into a mainstream strategy within private equity. They provide liquidity in an otherwise illiquid asset class, making them crucial for both limited partners or LPs and general partners or GPs. Investors are increasingly viewing secondaries as a smart way to access private markets with potentially lower risk and faster distributions, avoiding the long wait times of traditional primary fund commitments. So what exactly are secondaries? At its core, the secondary market is where investors can buy and sell existing stakes in private equity, venture capital, and private credit funds. This means instead of directly investing in a new fund, you're purchasing an interest from an existing investor who wants to exit early. Instead of waiting 10 or more years for a fund to mature and return capital, LPs can sell their stakes to a secondary buyer, often expediting their liquidity. For buyers, this means getting access to existing, often partially deployed portfolios, frequently at a discount to their net asset value or NAV. Let's break down the motivations. Why do limited partners sell, and why are secondary buyers so eager to step in? Limited partners, or LPs, often sell for several key reasons. They might have liquidity needs, perhaps to meet unexpected capital calls or to redeploy cash into other strategies. They might also engage in portfolio rebalancing, shifting between different strategies, vintage years, or geographies to optimize their overall exposure. And sometimes, regulatory changes or shifts in their own strategic mandates necessitate an early exit from certain fund commitments. On the flip side, secondary buyers enter the market for compelling reasons. They gain the opportunity to acquire stakes in mature portfolios with existing assets, offering greater visibility on performance compared to blind pool primary investments. This often comes with the ability to purchase assets at discounts to their net asset value. Plus, it provides instant diversification across multiple managers, vintage years, and sectors, without the typical blind pool risk of primary fund commitments. Liquidity needs can arise unexpectedly, and secondaries offer a vital escape hatch for LPs. Portfolio rebalancing allows sophisticated investors to fine-tune their exposure in a dynamic market. For buyers, the lure of immediate diversification, discounted entry, and access to already vetted performing assets is a powerful combination, bypassing the long J-curve of primary fund investments. The secondary market isn't monolithic. It's broadly divided into 2 main types of transactions, LP-led and GP-led. LP-led transactions are the classic form of secondaries. Here, limited partners initiate the sale of their fund stakes to new secondary buyers. These often involve large portfolio sales, sometimes spanning interests across multiple funds or even different fund managers. GP-led transactions, however, are a rapidly growing and transformative segment. These deals are driven by the general partners themselves, the fund managers, typically to extend or restructure their investment vehicles. This can include fund recapitalizations, tender offers, and most notably, the use of continuation funds. GP-led deals now account for roughly 50% of all secondary deal volume, highlighting their increasing importance. One of the most prominent forms of GP-led secondaries is the continuation fund. These vehicles are specifically designed to extend the life of prized assets within a private equity portfolio. Continuation funds allow general partners to move select portfolio companies, the ones they believe still have significant growth potential, into a new vehicle. This provides additional time and capital for these companies to mature further. Existing limited partners in the original fund are given an option. They can either sell their interest in those specific assets to the continuation fund, thereby gaining liquidity, or they can choose to roll their interest into the new structure, maintaining their exposure and potentially benefiting from future growth. For secondary buyers, participating in a continuation fund provides direct access to high-conviction assets that the general partner knows intimately and believes have strong future prospects, often without having to commit to an entirely new, diversified fund. Think of it like this. If a private equity fund invested in a promising tech or healthcare company early on, but the fund is nearing its end, a continuation fund allows the GP to hold onto that gem for longer, giving it more time to realize its full value. This has become a powerful tool for value creation. So who are the biggest players in this burgeoning market? Firms like Ardian, Lexington Partners, Blackstone Strategic Partners, and Coller Capital are titans in the secondary space. These firms have raised multi-billion-dollar dedicated secondary funds, allowing them to execute large, complex transactions. These firms dominate the secondary market with multi-billion-dollar dedicated funds. Their scale allows them to take on large portfolios and provide significant liquidity solutions. However, the market is also seeing growing competition from other large asset managers and even sophisticated pension funds looking to build their own secondary capabilities. We're also seeing increasing specialization, with dedicated funds focusing on venture secondaries, credit secondaries, or infrastructure secondaries. This increasing specialization allows investors to target specific segments of the private market, further refining their exposure and strategy. Now let's talk about the sheer scale of this market. The secondary market has witnessed explosive growth, now boasting over $100 billion in annual deal flow. To put that in perspective, the secondary market has grown tenfold in the past 2 decades alone, underscoring its pivotal role in private capital. This growth is driven by several factors, including larger private equity fund sizes, longer average holding periods for assets, and a greater number of limited partners actively seeking liquidity and portfolio management solutions. Looking ahead, market projections suggest that by 2025, the secondary market size could surpass $120 billion annually, with GP-led deals continuing to be the main growth engine, cementing their place as a permanent feature of private markets. While promising, the secondary market isn't without its risks and challenges. Pricing uncertainty can be a significant factor, as valuing illiquid private assets can be complex. Regulatory concerns are also evolving as the market grows, bringing increased scrutiny and potential changes in compliance requirements. The future outlook for secondaries remains incredibly strong. As private markets continue to expand globally, secondaries will play an increasingly vital role in building essential liquidity and flexibility into this asset class. They are transforming how investors access and manage private equity exposure. Thank you for joining us on this comprehensive overview of the private equity secondaries market. We hope this has provided valuable insights into this dynamic and essential part of private capital. Remember, this content is for educational purposes only and should not be considered financial advice. Be sure to subscribe for more deep dives into complex financial topics.